Good morning, everybody, and welcome to our webinar, The Management Company, a Last Resort, and our wealth planning tool, in which we will provide you with some insights about the management company, how they can be used in an optimal manner, and some points of attention. Before we start, some practical points. The presentation can be downloaded at the right-hand side of the screen under the heading Handouts. At the end of the webinar, you will receive a certificate of GoToWebinar. That's the application in which you are actually watching at the moment. Questions can be entered via the chat function or the feedback form. If we still have time after this seminar, we will gladly answer those questions, but otherwise we will come back afterwards. First of all, let's have a brief look at today's agenda. I will start with the tax topics. Our partner Cato Aerts will then give an overview of some possible employment issues, and to conclude, our counsel, Florence Kolpaert, will discuss some corporate law aspects. So let's get started with focus on the tax aspects and especially the tax opportunities the use of a management company may have. In this part of the presentation, we will discuss the general tax benefits of the management company, distributions from the management company, some practical considerations when using a management company, and the management company as a vehicle for wealth planning. Let's start with stating the obvious with respect to the tax benefits of the management company. The current corporate income tax rates are much lower than the personal income tax rates. So one could easily think that the use of the management company has immediate benefit in terms of rates. But the important question is how to really benefit from it. Because accumulating profits in a company seems nice, as the profits will not be as heavily taxed as when they are directly realized by the manager or the shareholder, but eventually we want those profits out of the management company and to the shareholder or the manager. So what are the possibilities to get the money out of the company? And a first straightforward way is via remuneration or bonus. Such a remuneration or bonus is deductible as a professional expense for the company, but when we look at the other side, it becomes quickly expensive, as such a remuneration will of course be a professional income, which will be taxable at the progressive tax rates. There are some alternatives, as you can see on the slide, such as the reimbursement of expenses, pensions, working with insurances, working with interest on current accounts, but let's have a look at some other options as well. The best known way to get money out of a company is the payment of a dividends. An ordinary dividend distribution clearly doesn't bring much profits because there's a withholding tax of 30%. But there are also other possibilities which are more beneficial, and we will discuss those more beneficial options afterwards. One of the options is the VVPRB system, whereby you can make a dividend distribution at a reduced rate, but of course there are some conditions that have to be respected. When you use the VVPRB system, a more beneficial withholding tax rate will be applicable as of the second financial year after the contribution. In such case, the withholding tax rate will drop to 20%, and as of the third financial year after the contribution, the withholding tax rate will be lower to 15%. As I mentioned, there are some conditions that have to be respected, and first of all, it should concern a small company. The dividends should arise from new registered shares issued at the occasion of the incorporation or a capital increase. The shares are fully acquired with new cash contributions. The shares must be fully paid up, and it should concern non-preferred shares. Furthermore, it's necessary to hold the shares in full ownership as of the date of the issuance. Another option is the distribution from a liquidation reserve. When creating such a liquidation reserve, there's an anticipatory levy of 10%. But in addition, there will be a 5% levy in case there's a distribution from the liquidation reserve after 5 years, but there will be no additional taxation when the distribution occurs after the liquidation or upon liquidation. So it seems that the liquidation reserve is an attractive alternative, but again, there are some conditions that have to be fulfilled. Also, in this case, it should concern a small company, and the liquidation reserve should be placed and must remain on one or more separate accounts of the liability side of the balance sheet and may not serve as a basis for remuneration or reward. A form should be added to the corporate income tax return as well to justify the liquidation reserve. The repurchase of shares by the company doesn't seem to be a very interesting option, as the part that is considered a dividend is also subject to a 30% withholding tax. However, there's only a deemed dividend in case certain events occur. They are mentioned on the slides. You can see it when write-downs are booked on the acquired shares, upon disposal of the shares with a capital loss, upon nullification of the shares by operation of law or otherwise, and lastly, upon dissolution of the company. Lastly, one might think that the sale of shares of the management company is the way to go, as we have the idea that capital gains on shares are tax-free in Belgium. However, one should not be overly excited because there are situations in which such a capital gain on shares will indeed be taxable at a personal level. First, in case the capital gain on shares is realized in the course of a professional activity. In such a case, this capital gain will constitute professional income and it will be taxable at the normal progressive tax rates. However, taxation as a professional income is rather exceptional, and the tax authorities mainly apply this to shares that are earned as an additional form of remuneration or as a professional profit. It is rarely taxed as a professional income in case the shares have been held for a long time, even if the shares represent capital of a company in which the person is also professionally active, as, for example, a CEO or a manager. Capital gains on shares realized in the private sphere remain tax-free. This is the case if they result from normal operations of management of a private portfolio. And in order to verify whether such gains fall within the scope of the normal operations of management of a private portfolio, case law attaches importance to the importance of the transaction, the recurrence or not, the method of financing, so on. In case the gains do not fall within the scope of the normal operations of management of a private portfolio, they will be taxed as speculative gains at a rate of 33%. Another exception exists in case the shares represent a substantial interest in a Belgian company and if the shares are transferred outside the European Economic Area. In such a case, such gains will be taxed at 16.5%. Now, let's have a look at some practical considerations when using a management company. The first point of attention is the problem of simulation, because indeed, prudence is the way forward. When making use of a management company, it is important that the management company actually performs its own activities. In this respect, a substance over form approach applies. The management company should have its own tax identity, and it's also to have important to have a written agreement, but such an agreement is not at all sufficient. The proof of the existence and delivery of actual management services by the company is in this respect crucial. So it's important to keep record of the performance of the management company itself, and this for evidentiary purposes. Another point of attention is the deductibility of management fees at the operating level. In this respect, the general conditions of Article 49 of the Belgian Income Tax Code apply, which are in fact the normal rules to deduct professional expenses. So the expenses should be incurred or borne by the taxpayer during the taxable periods in order to obtain or maintain the taxable income, and the authenticity and the amount should be justified by documentary evidence, or in cases this is not possible, by any other means of proof permitted by common law, except the oaths. The Belgian Supreme Court has already stressed the importance of demonstrating the reality of underlying performance. In this respect, the Belgian Supreme Court has ruled that Article 49 of the Income Code in principle does not allow the deduction of expenses that do not correspond to actual services, which seems logical. The taxpayer must provide proof that the expenses whose deduction is claimed correspond to services actually rendered. And the court also states that a non-simulated agreement by itself is not sufficient to provide proof that fees are effectively based on services actually rendered. So to conclude, the submission of a written agreement, invoices, and payment thereof is not at all sufficient and constitutes only a beginning of proof. Other objective data must be available to actually prove the reality of the performance, so the actual performance of the services by the management company itself and not by some manager or another employee of the company. Then the next topic is the expense deduction within the management company itself. Again, the general conditions of Article 49 of the Income Tax Code apply, which we have already discussed before. And by way of example, the following expenses may be deducted: car expenses, restaurant expenses, travel expenses, costs related to real estate. So it actually concerns the normal expenses that every company should be able to deduct when professionally made, and when all the conditions of Article 49 are respected, and the normal deduction limitations, if applicable, also apply in case of a management company, of course. When we look at the other side, benefits in kind granted to the manager of the management company will be taxable as professional income, given the causal link between the benefit enjoyed and the mandate exercised. Those benefits in kind are taxable, and the actual value or a lump sum amount will be taken into account. As we all know, there are a lot of lump sums provided in law, such as the free use of property, free electricity or heating, free provision of computers, tablets, cell phones, and those lump sums are often very favorable. However, in the current economic climate, such lump sums are under pressure, and the question is whether in the future they will exist as we know them at the moment. After these practicalities, we have come to the final part of the tax section of this webinar, the management company as a vehicle for wealth planning. Indeed, I think that it's clear from the previous part that working with a management company is not per se tax efficient, but this doesn't mean that the management company doesn't have any other tax or other benefits, especially in the long term. We all know that dying in Belgium is expensive, and let's be honest, nobody likes to pay taxes. Just have a look at the inheritance tax rates, and it becomes clear that looking for ways to lower the tax burden seems obvious. That's why it might be more convenient to plan our succession in advance. Indeed, the gift taxes for movable property are much lower than the inheritance taxes. And the donation of shares, including the donation of shares of a management company, is considered a donation of movable property. So by donating our shares, we can already lower those taxes. Furthermore, there's a special rate and even an exemption in case of the donation or the inheritance of family enterprises or family companies. In such a case, there is an exemption of gift taxes, as the legislator wanted to encourage entrepreneurs to think about their succession before their deaths. By exempting the donation, the legislator supports the early succession and the planned continuity of family businesses. In case the entrepreneur hasn't taken action before his death, the legislator has still provided for a lower rate or a favorable inheritance tax rate, as you can see on the slides. Of course, the application of the exemption or the lower rates comes with the fulfillment of conditions, and those conditions concern the family nature of the business. There's also a participation condition. A special procedure should be complied with, so certain documents have to be transferred, and in case of a donation, this should be established in an authentic deed. The conditions should sometimes permanently be fulfilled even after the transfer, and it's also possible to ask for a certificate in which it is confirmed that all the conditions have been fulfilled. By giving some considerations on the management company as a tool for wealth planning, the tax part has come to an end. I hope that this part of the presentation has given you some insights on the tax aspects of the use of a management company. And I would now like to leave the floor to Kato Aerts, who will continue this webinar.
Thank you, Anja. Hello, everyone. Also, on my behalf, welcome to this webinar about the management company. We're very happy that you are so many today. My name is Kato Aerts. I'm a partner in our employment pensions and benefits practice, and I will discuss the employment issues related to a management company. Next slide, please. An overview of what we'll be discussing is here on the next slide. Probably most of you, when you think of a management company, have also thought about the issue of self-employment, and that is the main attention point I would like to discuss with you today. So first of all, we'll look at what self-employment is. Is the grass really greener on the other side? Then we'll talk about the assessment of false self-employment and, of course, the risks related to it, because that is why it's important to discuss it today. And then, of course, whether the management company as such can be an argument against false self-employment, and whether you can use it as a way to protect your business if you are engaging a management company or an independent contractor. And then as a last point, I would like to mention the management company as a corporate mandatory in another company, or a management company as a service provider. Next slide, please. First of all, self-employment. Is the grass really greener on the other side? What's important for you to know is that in Belgium, employees or any worker can choose whether they would like to work under an employment contract as an employee or as an independent service provider. The reason why you would choose for one or the other are twofold. The first one is a financial consideration. As you can see on the table here, employees pay considerably more social security contributions. Those are, of course, payable by the employer. Some of them are deducted from the gross payment. But in the end, employing someone through an employment contract will be significantly more expensive than engaging an independent contractor. You can see here that the employer contributions amount to around 25%, employee contributions 13.07%, and there is no ceiling. So that means that regardless of how much the employee earns, those percentages will apply, and that can be a very substantial amount, of course, if you have a high earner engaged in your company. That is totally different for independent service providers. There you can see that the percentage is, first of all, much lower. It's 20.5% until a certain threshold. Then if the salary exceeds, or if the fees exceed 70,000 euros up until 104,000, more or less, the percentage goes down to 14.16%. And above that threshold, there is no social security contribution to be paid. So that means there is a significant gap between what an independent contractor has to pay in terms of social security and an employee, and that is often the reason why companies and also the independent service providers themselves are looking into a relationship of independent service provision. The second consideration is flexibility. Of course, if you engage an employee, employment law will apply, which means that you have less contractual freedom because an employee is protected by Belgian employment law. That ranges from minimum wages to maximum working hours. There is guaranteed vacation that is also paid. There is guaranteed pay that is due in case of sickness. And all of those things are, of course, more beneficial for the employee, or maybe less desirable for the company engaging that person. There is also mandatory indexation. That is something that most of you have heard about, of course, this year. There's a year-end bonus to be paid, double vacation pay. And then in the end, when the cooperation comes to an end, there are mandatory dismissal rules that apply to employees, where these do not apply to independent service providers. So choosing for an independent service contract might also have to do with the fact that you are much more flexible to work with an independent service provider who is not bound by all of these restrictions. Next slide, please. And then what is false self-employment, of course, because I've mentioned at the beginning of my presentation that parties can choose what they engage in. So they can choose to either go for an employment contract or a self-employed status. Well, a self-employed person is an employee who falsely claims self-employed status because in reality they perform their services in a manner of an employee bound by an employment contract, which basically means that they are performing work for an employer and they work under the authority of that employer. So the choice is there. You can choose for an employment contract or a self-employed status, but the choice needs to be compatible with the facts. If that is not the case, then we're talking about false self-employment, and that is where the risk kicks in. Next slide, please. The assessment of false self-employment is, of course, something that is high on the agenda of Social Security audits. It has been for years, and that has not decreased, quite the contrary. And there is a legal framework governing this, because, of course, parties, if there's a free choice to make, need to know what the criteria are to make that choice and to make sure that their choice is compatible with the facts. The legislation here on the slide is one thing, which is of course interesting if you would like to read the act itself, but I would definitely recommend you to go to this website, commissiearbeidsrelaties.belgium.be, because there you can find an overview of all applicable regulations, including those specific regulations for specific sectors. Because our government has identified some sectors as particularly prone to fraud, or where the risk is much higher, because in these sectors there might be more false self-employed workers than in other sectors, and their specific criteria will apply. So that is important to look at it. And it's a very good website with a general overview. What I can tell you in the short time span that we have is that there are 4 general criteria that are put forward by this legislation to determine whether an employee or a worker is a self-employed person or an employee. The 4 general criteria are, first of all, the will of the parties. The will of the parties is a very important one. As I mentioned, you have a free choice on how you want to work together, which also means that you have to make use of that choice and put it somewhere in a contract. If you don't have a contract, there is no explicit will of the parties that can be expressed. So if you are engaging a self-employed worker, make sure to have a contract in place where you specifically say that it is a self-employed worker and that is the will of the party. The second criterion is the freedom regarding the work to be performed. Is the worker free to decide how the work will be performed, or are there strict guidelines as you would ordinarily give to an employee? The third criterion is the freedom in the organization of the working time. That is a very important one. An employee will often be required to present at a certain time and to stay on company premises during the entire time and cannot just freely leave or decide to stop work earlier. That is not the case for a self-employed person. When I mention this criterion, often the question arises, well, can't you not do any checks on the self-employed worker, or are they just free to do whatever they please? The answer is, of course, no, but it's a different kind of check. So, and that's where the fourth criterion comes into play. When you are dealing with a self-employed worker, you will generally not perform any hierarchical control over this person as you would ordinarily do with an employee. For instance, you will not do any appraisal interviews, you will not impose any disciplinary sanctions. If you are not happy with the work that is being performed, you will either just not pay the invoices or terminate the cooperation altogether. Next slide, please. I mentioned some specific criteria. So the 4 general criteria apply in all sectors, but in certain risk sectors, there are some specific criteria. What is useful for you to know is, of course, whether you are active in one of those risk sectors, but secondly, also if you are not, it might give some more guidance as to the 4 general criteria, because those 4 general criteria are fairly vague. These 9 criteria help you in assessing the situation in a more factual way. What is also important is that there is a rebuttable presumption. If 5 out of the 9 criteria are met, you are presumed to be engaged through an employment contract. It is rebuttable, so you can present proof to the contrary to state that it's not actually an employment contract, but a self-employed service contract. But of course, since there is a presumption in place, that is not always easy to deliver. Next slide, please. Then we come to the assessment of the false self-employment and the rulings. You may have heard about the Administrative Commission to Regulate Labor Relations. This commission was established in 2013 and was basically put in place to help parties choose the right qualification of their employment relationship. And you can go to this commission to ask for their opinion if you are in doubt. The reason why I'm mentioning it here is twofold. First of all, of course, if you are in genuine doubt about the qualification of your relationship, you can go to this commission. Practice has shown that it's not been hugely popular in the years that the commission has been in place, because it feels a bit like going to the social audit yourself to present a case. And if you are not genuinely willing to adapt your choice based on their findings, then of course you are at risk, because if they make a decision and, for instance, say that based on the presented facts, this employment relationship is an employee relationship under an employment contract, and you decide to do the opposite, then of course the risk is much higher that you will get caught and that indeed there is a recharacterization of the relationship. On the other hand, that's the second reason why we're mentioning this. If you are interested in what this commission has to say, because of course it has ruled over several cases in the past years, you can look at their yearly plan, which they publish on their website. And there you can even go to similar cases or similar sectors that you are active in, where you can see what the factual criteria are that they use to determine the nature of the employment relationship. And since we're talking about the management company today, you can find numerous decisions also where management companies were involved. I will discuss that in a minute. Next slide, please. Now, all of this theory is, of course, very interesting, but the main reason why we're talking about it today is, of course, the actual risk that is involved if you are engaging with a false self-employed person. The risk comes from either the Social Security Administration, on rare occasions the tax authorities, because as you've seen in the first slide, with the overview, taxes are more or less the same. It's mainly the Social Security Administration where, well, a certain benefit can be obtained if you work with a self-employed worker instead of an employee. Of course, if you work with a management company, as Anja already discussed, you can optimize your income through that management company. But most of the time, we see that the initiative is taken by the Social Security Administration to recharacterize an employment relationship. And then it could also come from the independent service provider, of course. Usually when parties are very happy and at the start of the cooperation, everything goes well and the independent service provider is very happy that he or she qualifies as such. But then in the end, when you terminate the contract and they are faced with a very short notice period, they might want to argue that in fact they were employee, because then not only they could claim a higher dismissal compensation, but they could go back in time for payment of all other benefits that would be due to an employee, such as vacation pay, end of year premium, overtime payment, etc. The payment of Social Security contributions, I've mentioned the percentages already, so 25% plus 13.07%, and on top of that, you have 10% contribution surcharge and a negligence interest of 7%, and that can go back for 3 years. On every payment that has been made to the independent service provider. So you can make the calculations yourself. It's going to be a very expensive result, especially in case of fraud. They can even go back 10 years in time. And all of that, and that is the main attention point here, all of that is not recoverable from the employee, because the legislation clearly stipulates that any due payments in terms of Social Security cannot be recovered from the employee. If the independent contractor qualifies as an employee, then that is not possible. There is light at the end of the tunnel, and I'm very happy to announce during this webinar on the management company that there is a possibility to recover it from the management company. So that's one of the main takeaways of my presentation today. If you work with an independent service provider and that independent service provider works through a management company, you can protect yourself by adding a clause in the contract that stipulates that any payment of Social Security contributions can be recovered from the management company. Another risk is, of course, overdue withholding taxes, administrative or criminal fines. I've mentioned earlier that, of course, the entire labor law or employment law will apply, which also means that you may have infringed many obligations in relation to Belgian employment law, such as the prohibition to let workers work on a Sunday, at night. And if all of those things happen in practice, then of course you're liable to fines as well for those violations. And then, of course, the benefits due to the employee, which I have already mentioned. Next slide, please. So how can the management company then be used as an argument against false self-employment? And that's where it becomes interesting. An employee is, per definition, a natural person. So that means that a company cannot be an employee. Does that mean that there cannot be any recharacterization if you are working with a management company? No, but and case law has consistently ruled this, that you'd have to first pierce the corporate veil and basically say that the management company that you have engaged is only a structure, a fraudulent structure, and that you've never had the actual intention to engage the management company itself, but rather the person behind the management company. And of course, the second protection that you can invoke is a safeguard clause that I've mentioned already, so you can recover Social Security payments in case of recharacterization from the management company, provided, of course, that the management company still has funds. You can recover those payments from the company. Next slide, please. Here you see an overview of recent case law where what I've just explained has been confirmed by courts. So again, it was confirmed in Ghent that the partnership between two legal entities excludes a subordinate relationship because an employee is only a natural person and not a company, and that feigning or piercing the corporate veil will be necessary. I think the last one on the slide is also interesting because there it is a very theoretical approach where the tribunal in Brussels has looked at piercing the corporate veil and has also looked at the lack of consent. So basically, from the factual circumstances, it appears that there was never really an intention and a consent between parties to engage a company, but rather a person behind the management company. Then that was also a reason to pierce the corporate veil and to state that there was indeed an employment contract in place between the parties. Next slide, please. And then, of course, you can either go to a court in Belgium, but as I mentioned earlier, you could also go to that administrative commission, not in case of a dispute, but it's rather at the start of a relationship where you are in doubt of what the qualification of the relationship is. You can go to the administrative commission and ask what their opinion is on the relationship that you are intending to enter into. And here on this topic, there were several rulings by the Administrative Commission, which you can consult on the slide that I've mentioned earlier. And there, in several cases, they said, well, your request is in fact inadmissible because we are facing here a contract between two companies, and that is not possible for an employment contract in the first place. But in some decisions, they looked a bit further and they looked at whether or not there was feigning, and they did or did not have to pierce the corporate veil. And I think on the bottom of the slide is the most interesting part of this, this explanation, where you can see what the arguments were that they used to say that, in fact, it was not the intention to engage the management company, but rather the person behind the management company. And that was, for instance, the case where in the service agreement, there was a clause showing direct contractual relationships with a natural person. So in that case, they just looked at the contract and they saw that in many clauses, there was actually not really an obligation for the management company itself, but rather for the natural person behind the management company. And that was the reason for the commission to say that it's actually a fraudulent structure and that the management company was just, could be put aside. And there was, in fact, an employment relationship between the company and the natural person. Another one was the fact that prior approval was needed to designate another executor, where again, that was a reason for the commission to say, in fact, you were not really wanting to engage the management company, but rather a person behind the management company. And then a third one, I think a more creative one, was the wish for experienced advice and support. As you've probably seen a lot in service contracts in the recitals, it states that the company wants to engage the experienced advice and support from said management company. And there the commission ruled, well, actually, if you want to engage experienced advice and support from a management company that has just been established, that's not very credible because that management company does not have any experience in this sector. It was newly established. You're actually looking for the experience and advice from the person behind the management company. It's a creative solution, I would say. Don't know if I really agree with that because, of course, the person behind the company will always, in any case, with any management company, even if it existed for 5 or 10 years, be the one with experienced advice and support. So, but it's interesting for you as a takeaway that that was one of the arguments of the commission. Next slide, please. The safeguard clause, this is just an example. I will not read it out loud. That will just be a waste of time, but please use this clause if you engage a management company, because that is the clause that will protect you to be able to recover Social Security contributions from the management company in case of recharacterization. Next slide, please. And then a final point of my presentation, the management company as a corporate agent or service provider. I think what is particularly noteworthy in Belgium is that a corporate mandate or an office in a body of the target company can also be a management company, and that happens quite a lot. Well, in that case, you have, of course, a legal presumption that the person behind that management company is, and the management company itself is deemed to be a self-employed person. A distinction should be made where the management company does not have a corporate mandate, but is rather a service provider, because there is no legal presumption, and then that's where the risk of requalification comes into place. Next slide, please. Can you accumulate holding a corporate mandate and then also being a service provider? Yes. Can you accumulate being or holding a corporate mandate and then also having next to that an employment contract if you are operationally active in the company? The answer is yes, that is possible as well. So that's why it's very important, if the management company and the person behind the management company are rendering services, that you really make sure this relationship is well documented, and that in practice it is also executed as such. Because if it can appear that in fact there is also some operational activity of the person behind the management company who is performing a clearly distinguishable task under the authority of the company and receives wages in return, then of course it could very well be that this person, even though they are holding a corporate mandate, that they are in fact also employed as an employee on the basis of an employment contract for their operational tasks in the company. Next slide, thank you. And then the last one is the presumption in Article 5 bis of the Employment Contracts Act, and that is irrebuttable. So there, proof to the contrary cannot be provided, which in summary says that if you are performing activities both as an independent service provider, so a self-employed person, and also as an employee of the same company, and you are performing similar services, that you are deemed to be an employee for the whole of the task that you are performing for that company. That's in a way logical. It would be very difficult to argue that on Monday and Tuesday you are an independent service provider, and on Wednesday, Thursday, and Friday you're, for the same job, an employee. So that's not possible under Belgian law. What is possible is, of course, different activities. So that could be, for instance, someone who's working in accounting, and they have started their own business in graphic design, and then on Friday they perform other activities for that same company. That would be possible, and then this article would not apply. So that was it. Thank you so much for your attention. And of course, if you have any questions, feel free to reach out. I am gladly giving the floor to my colleague, Florence, who will discuss the corporate law aspects.
Thank you, Kato. Welcome, everyone. My name is Florence Kolpaert, and I will be talking about the corporate law aspects of incorporating or working with a management company. So when you envisage to incorporate a management company, one of the first corporate questions that will arise will be, which company form are you going to use? You know probably that since 2019, we have a new code of companies and associations that entered into force. A little side note that the deadline to implement the change of articles of association to put them in compliance with this new code expires at the end of the year, so don't forget to amend your articles. But what has this new code of companies and associations done? It has basically simplified greatly Belgian corporate law, and especially the numbers of company forms, where in the past we had a lot of a variety of different forms. Today, all these forms have been reduced. And the code has also basically made the BV, or SRL in French, which is the limited liability company, has made it more flexible, which means that today it will be one of the standard company forms that are used when people envisage to incorporate a management company. What are the advantages of such a structure like the limited liability company is that you can incorporate it with just one founder, which is quite easy. You also don't need a minimum capital anymore. So the company will need in any case to have sufficient financial means, of course, and those sufficient financial means can take different forms. They will also need to be justified in a special financial plan, which is drawn up by the founders or the founder at incorporation, and on which the founders take liability in case there would be a bankruptcy in the first few years of the company, and it would appear that those financial means to start the company were obviously not sufficient. So that's still an important requirement, but you do not need anymore to have, let's say, a set amount of capital when you incorporate a BV. It's also possible nowadays to have multiple voting rights for the shareholders, which was not the case in the past. It's not possible to have multiple voting rights for directors, though. That's still tricky. But also what the code has done is that in the past, the BV had mandatory set of share transfer restrictions, which made it really private by nature, and that is no longer the case. So you can deviate from those, let's say, standard share transfer restrictions in your articles of association. The code has also formalized the self-employed status of directors, so making it clear that the mandate of a director cannot be exercised through an employment agreement, which makes sense, like Kato explained. Something new as well in the code is a cap on directors' liability. I'll get back to that a bit later on in my presentation. Sounds like a good idea, but we'll see that in practice its usage will be unfortunately a little bit limited. What is also new is the fact that the code now provides that a single natural person cannot accumulate several mandates in the same entity in different capacities. So you can no longer be a director yourself and a director through a management company. So we'll also get back to that a little bit later on. And then a last important point to take into account when you are about to incorporate a ManCo is the fact that you need to comply with the conflict of interest regulation, which means that when your ManCo is contracting with yourself, for example, your ManCo is renting out a space in your house, your private house, you are on both sides of the transaction. It means that you need to apply the conflict of interest procedure. And if you don't, then you incur a liability. So that's an important one as well to keep in mind. So you basically, what we see is that the most common forms of companies that are used or entities that are used for a management company are either the limited liability company, of which I already talked about, or the limited partnership, the COMV, Société en Commandite. The advantages of that limited partnership is that, let's say, it is simpler to incorporate because you can do so by private deed. You can also change your articles by private deed, which is not the case of a BV, for which you need to go to the notary. But at the same time, you also need to have two founders, of which one unlimited partner at least and one limited partner. And of course, the unlimited partner will have unlimited liability, so will be jointly and severally liable for the commitments of the partnership. So for that reason, people often opt for a limited liability company. I've already mentioned the main characteristics, but another important one, which is at the bottom of the slide, is the fact that when you want to distribute profit, you need the directors will need to perform a double distribution test, meaning that on the one hand, they need to verify that the net assets of the company are not negative and that they will not become negative as a result of the distribution. And on the other hand, they also need to check that the company actually has the liquidities to distribute that profit, to pay that profit. That double test is new. It's been introduced by the new code, and there is a director's liability attached to it if that test is not performed, or if the test has been done but it has a negative result, and there's a distribution anyway. So that's an important one as well to keep in mind when you have a ManCo under the form of a BV. So you have incorporated your ManCo, you chose for a BV, for example. Can your ManCo exercise then corporate mandates in other entities? The answer is yes, good news. Your ManCo can be appointed as delegated to the daily management, managing director, or member of a board, supervisory board, or executive board. What the new code has also introduced is the fact that if your ManCo is appointed as a director, for example, it needs to designate one physical person that will be the permanent representative and will basically perform that mandate for the ManCo. It is not possible anymore to have what we sometimes had in the past, which was a sort of cascade where the ManCo was appointed, then would designate another legal entity, and the legal entity would then designate a physical person. So nowadays, if your ManCo is appointed, it has to appoint directly one natural person as permanent representative. Another point of attention with respect to the corporate mandate of your ManCo is the fact that a director can be revocable, what we say ad nutum, meaning at any time without any justification needed and without indemnification either. So that's the principle. It used to be of public order for the NVs, and so the public limited liability companies. That's no longer the case, but that's still the principle. So that's for your corporate mandate. You can also have, next to your corporate mandate, like Cato mentioned it, a management agreement. So that needs to cover other tasks than the ones of your directorship. And in that management agreement, you can, of course, it's a contract, you can provide for a termination notice, you can provide for an indemnity that is paid under certain circumstances. So you are more free to regulate your relationship in the management agreement. And if your management agreement is terminated, it does not necessarily mean that your corporate mandate is terminated, but of course, often it will go together. So often, if the management agreement is terminated, the shareholders will also terminate your corporate mandate. So you have your management company, and your management company is now a director. of another entity. And you, as manager, are the permanent representative. What is your liability? What is the liability of your ManCo? And what is your own liability as permanent representative? Well, the new code provides that the natural person who is the permanent representative of the ManCo actually incurs the same liability as if the natural person was himself or herself appointed as director. And so you cannot hide behind your ManCo with respect to your liability. This applies to your directorship, but also to appointments like the daily management. So you will incur the same liability, but which liability are we talking about? So you have several layers, let's say. The first one is the corporate liability coming from the company's code. So directors may be held liable for management faults, but also if they breach the law or the articles of association. And you also have in certain specific laws or certain articles of the code a specific liability, for example, for in case of bankruptcy or in case of the non-payment of certain taxes. So that's, let's say, the first layer, that's the corporate liability. The second layer is your contractual liability. If you have a management agreement, for example, of course, you can incur a liability under that agreement. That will depend whether you take obligations of means, which are lighter, or obligations of result, of course, under your contract. You can also limit your liability to a certain extent, of course, but the contract is more, let's say, modular. And the damages that will be recoverable by the company are the foreseeable and direct damages. So that's second layer, your contractual liability. And the third one is, of course, like everyone else, the extra contractual liability to third parties in case you commit a fault and that fault has caused a damage to a third party. In Belgian law, you have some limitations on the combination of claims under contractual liability and tort liability, extra contractual liability. Okay, so that's our liability. What can we do about it, right? So how can we limit that liability? Well, first, if you're a director, you have to speak up, right? So if you are becoming aware of wrongful actions, you have to notify the board of directors, and you should definitely make sure that this is reflected in the minutes of the board of directors to make sure that it's clear that you did not participate to those wrongful actions and that you also raised the flag, so to speak. So that's the first thing to do. Then if you have a management agreement, you can, like I said, limit your liability or exclude certain risks. You can, and probably you should, take a professional liability insurance. For corporate mandates, that's an important thing. You have to make sure that every year when the annual accounts are approved, you have to make sure that you get the discharge from the corporate body that has appointed you. So for directors, that will be the shareholders, and for daily managers, that will be the board of directors. So that has to happen every year, and the discharge that is granted to the director who's a ManCo will also apply to the permanent representative of the ManCo, so you will be covered as well. It has to be a valid discharge. There are some conditions for that, and it will be enforceable only against the company that has granted the discharge, of course, so this doesn't count for third parties. We also see in practice that sometimes directors enter into an indemnity agreement or waiver of recourse with the company, or that the company is taking what we call a D&O insurance policy. So the company itself, the company of which you're a director, takes the insurance, and then you and your ManCo will be the insured parties under that D&O policy. And then the last possibility to limit your liability is what I mentioned in the beginning of my presentation, the famous cap that has been introduced by the new code, the cap on directors' liability. So you will see here on the screen that the cap is on the left. That's the maximum liability, which depends on the average annual turnover and the average balance sheet total of the last 3 financial years. So the higher the turnover and the balance sheet, and or the balance sheet, the higher the cap, of course. The issue here a little bit is that this cap does not apply to common minor errors. It also doesn't apply to gross misconduct or fraudulent intent. So we're already excluding quite a lot of mismanagement, let's say. And it's also not applicable to specific joint and several liabilities, which result from unpaid withholding taxes, unpaid VAT, unpaid social security contributions in case of bankruptcy of the company. So it was a good idea, but unfortunately, let's say the scope of application in practice will be quite limited. So we're coming to the end of my presentation. I don't know if we have really time for Q&As. I see that we have a number of interesting questions. I would maybe suggest that we tackle them by email. So we will answer all the questions that are in the chat at the moment. And if you would have other questions after this seminar, don't hesitate to contact us, of course. We have you have our contact details on the screen. We'll be more than happy to answer any of your questions. So I thank you for your attention and your presence today, and we look forward to seeing you soon. Have a good day.